Bitcoin's crashing. What is happening? Well, I have good news, my friends. It is the beginning of a new month, and that means it is time for your piping hot Bitcoin Monthly Digest, where we pick apart questions such as that and a whole lot more. Let's jump in. Welcome back to another video. My name is Ian Major. I'm an entrepreneur, Bitcoin pleb, and all-around raging capitalist. And yes, we've got a lot of ground to cover today. For those who are newer to the channel, I welcome you, my friends, to the party. I do this as a monthly series to kind of go through some of the major happenings over the last month, as well as, things that are coming up in the near term. But I don't do this as a way to sort of predict near-term price movement. Frankly, I could care less about the fiat exchange rate of Bitcoin. What matters most is that 1 Bitcoin equals 1 Bitcoin. 1,000 sats equals 1,000 sats. That, my friends, is the exchange rate that truly matters. And the reason I do these videos, and today's edition, I'm actually going to go more deep into the recent price action than I usually do, as a way to kind of talk through some of the really important parts of this market, better or worse, that we should understand. And all of this is to build your conviction for Bitcoin such that you have steely diamond hands and aren't getting shaken out like a lot of folks were over this last little bit. So today we're going to focus a lot on recent price action as a way to kind of talk through some of the kind of derivatives markets that are now playing a pretty big role and have continued to play a big role in the price of Bitcoin. And we're going to then talk about some of the recent news with Jack Dorsey. And his mission to deepen his involvement even further into all things Bitcoin. Very exciting stuff. And we'll cover some other topics along the way, so you won't want to miss a thing. I recently put out an entire Bitcoin beginner series. This is an 8-part video series, a really nicely packaged, distilled, and synthesized kind of holistic intro video series for beginners. And so if you're orange pilling someone you love this holiday season, I encourage you to put this in your toolkit and arsenal. But enough with all that. Let's go ahead and jump into the meat for today and talk first about the recent price action. All right, so just as a recap, we started the month of November well in the 60s. And as the making of this video, we are in the upper 40s. So quite a decline. But why did we see it? What's going on? These and many other questions we shall answer as part of today. And the story, of course, is a complex one, but it really comes down in large part to a lot of the kind of derivatives activity we've seen in the market taking place over the last several months. Now, I'm going to get pretty nerdy and financy on you for a little bit here, just because, one, I think it's interesting, but two, make no mistake, this is definitely playing a big role in the Bitcoin market, and so it's important to be aware of what it is and what influence it can have, because once you see events like what we just saw unfold over the last few days, you'll be better informed to be like, oh, like that's what happened, nothing to worry here. Move on, move along. And so Dylan here captures it nicely. You definitely still have Bitcoin being labeled a kind of risk asset. And so some of the kind of traditional money managers around the world who are investing in this very much see this similar as they see the stock market, the S&P 500, etc. One day that will change. Bitcoin is a safe haven asset, as many watching can agree. But suffice it to say that, you started having some new kind of scares with COVID, with Omicron and all this stuff. You generally had some additional kind of macro risk with the Fed insisting and trying to insist that it's actually going to be a responsible steward of the US dollar and cut its monthly purchases of bonds. It further reiterated that, saying that it may even accelerate the pace at which it withdraws liquidity. Now, as a quick aside, I would encourage you guys to go follow Luke Grommen, who puts out some fantastic analysis and sort of shows why this tapering of QE is being offset in other ways. And so make no mistake, the Fed is trying to convince the world, and particularly bondholders of U.S. Treasuries, that they're going to be responsible and that they're going to, they're not going to hyperinflate the currency. Don't worry, there's nothing to see here, guys. That's the kind of story they're trying to tell with this tapering. But meanwhile, they're sort of stuffing liquidity through other vehicles and instruments. And so it's a little bit sneaky. No, not many in the market realize kind of what's happening. But once they do, it'll sort of be like, okay, got it. So the Fed's not actually taking, liquidity away on net. But anyway, you have this sort of perfect macro cocktail of, COVID fears. Simultaneously, the Fed is, threatening to take away support for markets, even more quickly than they say they're going to. And so this, of course, spooked the traditional equity markets. You saw the VIX here spike up pretty high. The VIX is basically a measure of volatility on the S&P 500. And so you can see that massive spike way back in March of 2020 with the initial sort of COVID humongous kind of sell-off. And, it's certainly the highest that it's been here, registering at 34 in, really basically this year, right? Like it's the highest it's been this year. And so that's significant. So all that started to kind of grind the price of Bitcoin lower. And now you throw in the sort of dynamite ingredient, which is the fact that we've seen funding rates increase and be in a very kind of positive regime for some time now, as we can see in the following chart. And so we see the price of Bitcoin here and the funding rate on perpetual futures. I'm going to explain all that in just a moment. But basically, you can see the kind of takeaway here is that really over the last several months, you've had just all green. And this is generally reflective of a kind of bullish market sentiment. A lot of people, expecting to see Moonvember and all this and that. In prior editions of this monthly series, I've covered Plan B's, worst case stock to flow kind of month end model, and how he was spot on in August, September, a little bit off in October, and then of course way off in November. And so it comes back to the old maxim that no models are correct. And some are useful. So let's just talk really quickly about what this is saying. So futures contract, let's go way back to the advent of futures contracts. It's really to help hedge against price movements in an underlying commodity. So let's say I'm a food manufacturer and I need to buy wheat from my farmers who are my suppliers. I might enter into a futures contract in order to lock in a price at which I'm going to buy said wheat at some point in the future. That is a futures contract. And so that is a tradable instrument. I could, there's value in this contract. It's basically the right to make a purchase of a commodity for a certain price at a certain time in the future. Now, you also have perpetual futures contracts, which are essentially the same thing, except there's no expiration, i.e. there's no settlement that takes place. So in my wheat example, at some point, that contract would either expire or we would actually settle the trade, i.e. I would, pay, as a food manufacturer, I would pay the farmer, and the wheat would be physically settled or physically delivered to me. And so the trade would complete at that point. Perpetual futures have no expiration. And in order to avoid the futures contract price from deviating too much from the spot price or the price of the underlying asset, you have something that's called the funding rate. Because what happens with traditional futures contracts is that as you get closer and closer to that expiration point, the price of the futures contract will converge to the spot price of the underlying asset. And it makes sense, right? If we're only a week out from the point at which this contract allows me to buy that wheat, it would make sense that the price of the contract itself should be converging towards the spot price. But of course, you don't have that mechanism with perpetual futures. And so the funding rate is what accomplishes that. So the funding rate is essentially some group of traders paying others, to keep their positions open. And so, for example, when funding rates are positive, this is reflecting the fact that the futures contract price is higher than the price of the underlying asset. And this is what we see typically in a kind of, where people are bullish. They expect the future price to go up. And so the futures contract price is higher than the spot price. And so the funding rate is positive. And what that means is that the long positions are actually paying the short positions. And the opposite is true when funding flips negative. So when funding goes negative, this is associated with the futures contract price being less than the current spot price, meaning, we're all of a sudden bearish now. The market is bearish. And in that situation, it is the short positions that are paying the long positions to remain open. And so you can kind of see like how this would be a mechanism to help reconverge the price if it's deviated over some time. And so if all that sounds like gobbledygook, just the takeaway from this is really that a sustained period of positive funding rates can be like a target on the back of certain traders. Because what happens is market makers and liquidity providers, or just kind of whales and traders in the market, see this happening, and they know, and they can look at all the leverage that, traders have taken on to establish these positions, right? Like you may have leveraged traders that are opening these positions in the kind of perpetual futures contracts. And so if I'm, for example, a massive whale entity and I'm seeing a lot of traders all doing kind of the same thing in a very leveraged way, it's kind of like this house of cards that's getting built on a very shaky foundation. And if I'm a whale and I have enough funds, I can actually blast that foundation wide open and let the house of cards all fall through cascading liquidations. So if my liquidation price is, 55,000 Bitcoin, if we hit that, I'm now forced to sell my Bitcoin. That applies yet more downward pressure. And so the next person who has their liquidation price at 54K gets liquidated, is forced to sell, and so on and so on and so on and so forth. And so that's how you can get these kind of massive spikes down through this cascade of liquidations. And again, it all comes back to this kind of target that's being put on their backs through persistently positive or negative, right? It can happen in either direction. And these market makers and these whale traders really don't care. Like, they don't care if it's positive or negative. It just represents an opportunity for them to profit. And so this was the perfect storm. You had a bunch of built up leverage, especially on the long side. So you have all these degenerate retail traders taking out leverage positions to go long on Bitcoin. You have that for a very sustainable period of time. And so all these kind of big whales are looking at this with, their mouths drooling, because they see opportunity. And then you place a little bit of pressure with those kind of macro factors we were discussing earlier, and you have the opportunity to strike. Whales can start selling to apply even more downward pressure, and eventually you get the kind of cascade of liquidations that drove us down below 50. I think even some exchanges I saw were, like in the 30s, like way below in the 30s. So it was a pretty big event, but again, nothing that's like wildly out of the ordinary for the Bitcoin market. And I actually think this is part of the beauty of this market. It's unfortunate that the people who get wrecked in this are dumb money, retail traders, but it kind of is what it is. Like, you take risk and you sometimes get burnt. I'm never trading any of this stuff, but it's important, I think, to understand these dynamics so that when you do see a huge, massive sell-off like this, you can immediately say like, this is the reason, this is why this happened. And so the outcome of all of this, as we can see in this updated view, I know this is a little bit blurry, but this is later in Dylan's thread. I'm going to link all of this in the description down below, but you can see that the funding rate has now flipped massively negative. Aligning exactly with the drop off in the price. And so this is in a way good news. It means that we have flushed a lot of the leverage from the system. And now we may see the opposite thing happen, right? You might see funding rate trend negative and stay negative, or maybe a little bit mixed for a while. And the opposite opportunity for these kind of market makers takes hold. And Will Clemente, one of my other favorite analysts, a lot of people follow, summarizes, I think, really well. He says, realizing more how the Bitcoin crypto market is about liquidity. MMs, or market makers, will drive price to the max area of pain for leveraged retail apes. People like Trabuco will keep drinking your milkshake. If we're going to go higher, need to create a period of disbelief/uncertainty at a minimum. And he gives this actually pretty similar example back last year. So what is he saying here? What is a market maker? A market maker is basically a liquidity provider that exchanges partner with that make profit on the spread of a trade. So if I have a whole boatload of Bitcoin as a market maker, I'll offer that to the market at a certain price and I'll make a spread on the trade. So I'm rendering a service for the exchange to provide liquidity for different market participants. So again, Will is commenting that there is an incentive, given that mechanism, there's an incentive for these market makers to drive price against where a lot of the leverage is concentrating in the system. And so again, it's kind of markets at work. Like all these degenerate retail traders, get levered up and think everything's going to the moon. And, these other market participants basically eat their lunch. And it happens time and time and time and time and time again. Like I promise you, unless you're one of the massive whale traders, you are going to get wrecked. You're going to get absolutely clobbered. And Sam Trabuco is going to eat your lunch, and he's going to love it. He's going to absolutely love your cheap sats that you just gave him. And so Sam is the CEO of Alameda Research. He's a quant crypto trader and one of the bigger sort of players in this. I'm going to link this thread in the description down below because it's actually a really, really interesting thread. It shines a lot of extra light beyond what I'm sort of saying in this kind of brief rundown. The summary of the thread is like, thank you very much for your lunch. Like that is essentially the summary, the too long didn't read version. Thank you for your lunch. And so that's really what we've seen. And so again, just to recap all of that, because I know I went quite deep this time around into some of these more sort of financial topics, but I think it's really important to understand so that you can look at the next one of these and just shake it off and say, awesome, thanks for the cheap sats for me to stack. It's on sale. Beautiful. We love those days. But again, you had a bunch of retail traders, dumb money, taking leverage positions. The more that happens and concentrates and builds up, the more opportunity there is for the Sam Trabucos of the world to go in and basically poke the little foundation under that leveraged house of cards and watch it all crumble and make a huge amount of profit in the process. These are just markets at work. Of course, the way to avoid this is to just hodl, right? Like 200% annual gains a year if you're that concerned about the fiat exchange rate, which I don't think you should be. I think you should be concerned about the total number of sats that you have in your stack. But that's not good enough. Maybe not for some folks. But they often pay the price, as we've just seen. Now, if we take a step back, it's pretty clear that this is a very sort of technicals-driven, derivative market-driven. Obviously, you do have some of the macro bits that kind of helped serve as the impetus for this. But beyond that, you have just a lot of really positive kind of fundamental news. Checkmatey has this view where he's looking at percent of Bitcoin supply held by wallets of certain sizes. So this particular one I chose is 0.1 Bitcoin to 1 Bitcoin, but he also has the other smaller band. So, 0.001 to 0.01 and so on and so forth. And so this is really showing us that, some of the smaller guys are stacking the dip. And you love to see it. So you're seeing an acceleration of these smaller wallets just continue its sort of climb. You're continuing to see more and more professional athletes and other folks take their salary in Bitcoin. Odell Beckham Jr. recently announced that he is taking his salary in Bitcoin. through the Cash App. So very cool to see. And ultimately, I really, really like this view from Dylan. This is the realized price of Bitcoin. And realized price is not the current kind of market price, but it's basically the price of coins at the last price at which they moved. So you can see that while there have been periods of sort of slight decline, keep in mind this is a log scale that this is being showed on, it has largely gone up and to the right. And so like this really, I think, helps smooth out a lot of the noise. And what Dylan is sort of demonstrating here or suggesting is that when you see realized price in a downtrend, it's a good sign that it is in a bear market. A steep uptrend is the opposite. And then something that's a little more kind of sideways trending, maybe a little bit upwards, is this kind of accumulation phase. And so all of this is to say that we'll probably continue to see some sideways movement and reaccumulation after that relatively large, event and liquidation of those different leverage longs. And so this backs up what a lot of folks are saying, that, this cycle, if we can even call it a cycle anymore, there's a lot of folks saying that we're not going to see future cycles like the ones that we've seen in the past. But regardless, even if we do see that, we're likely to only see it at this point in Q1 because no big firms or institutions are going to buy a lot, at the end of the year before the tax year closes. And so, if we do expect to see fireworks in the near future, it's probably going to be in the new year, which is similar to what we saw last year. But I think the even more important takeaways from all of this is that stay humble. Like the second you think you figured out the market, the second you will be wrong. And so stay humble, stack sats, but recognize that when these events happen, and again, they can happen to the downside or the upside, you can at least be more comfortable knowing what's driving this. And in the case of the downward case of what we've just seen, it's a great opportunity for us to pick up some relatively cheap sats. You'll love to see it. So with all of that kind of dissection out of the way, let's also talk about some of the other big news that's happening. All right, so one of the big pieces, of course, was the announcement of El Salvador and the Bitcoin bond. I've done an entire video on the nature of that offering. I think this is going to be really, really transformational for the global adoption of Bitcoin. And so I'm just going to leave that video for you to take a look at in the description down below, where I go through that in more detail. You also, of course, had El Salvador buying the dip. So this is President Bukele announcing that they're buying the dip. And you have missed the effing bottom by 7 minutes. It's an ongoing meme and joke that El Salvador has been literally out trading everyone else because they just somehow buy the bottom every single time. But anyway, you love to see it. Nation states buying the dip. But perhaps the even bigger news that we've seen over the last little bit is Jack leaving Twitter. Many believe this is in order to focus more exclusively on the world of Bitcoin. Jack has, of course, been a massive proponent and advocate of Bitcoin, with Cash App being a kind of early adopter for Bitcoin. And a lot of people will always point at what he said back in June during the Bitcoin conference, where he essentially hinted at, if he ever felt that he could contribute more to Bitcoin than Twitter, he would make the jump because he believes there's nothing more important to be working on in his lifetime than Bitcoin. And so as part of this, you also have the rebranding of Square into Block. And there's a thread here that I'll link in the description that kind of goes into the motivation behind that change. Block being this kind of multi-dimensional version of a Square, but it's really, really cool stuff. And one of the other things you saw is that Square Crypto, so the crypto arm of Square, has renamed itself to Spiral. And if you look at the handle, it is Spiral BTC. So you'll love to see it. It's a very clear, I think, sign of a focus and emphasis on Bitcoin, which is what Jack has always been about. Now, what not everyone, I think, has seen just yet is what they're calling TBD 545669975. Now, who knows if this sort of, is going to change. But what this is a liquidity protocol that Jack is building. This is going to be an open source liquidity protocol. And I encourage you to read the white paper. I might do a video where I go into this in depth because it is a pretty fascinating topic. But in essence, this is a protocol that attempts to allow people to form different networks of trust. And what I deem to be trustworthy might be different than what you deem to be trustworthy. One of the huge things that folks like Jeff Booth in the community have always said is we need to articulate and build tools that will facilitate the transition from the legacy world in which we live today to the Bitcoin standard world that we hope to live in the future, right? Like that is going to be a messy transition. It might be chaotic if the right tools aren't there. And folks who are not, early in the lifeboat may find themselves scrambling to get their place. But TBDEX, I think, is fitting directly into that objective and is basically building a protocol that would allow different entities within the ecosystem to interoperate with fiat on-ramps and then also create their own kind of networks of trust. You might have some folks who require no KYC whatsoever. You might have other services that do require KYC. And this is going to allow those different entities, consumers, services, platforms, etc., to all kind of agree on what they want that definition of trust to be and do so in a way to where you don't have a centralized kind of intermediary that's dictating what the trust definition should be. And so I think this is an absolutely fascinating thing that is very much worth taking the time to check out. Again, I'll link the white paper in the description down below. But I think this is very much in that theme of how we transition from where we are today to where we're heading with hyper-Bitcoinization in the future. But for now, let's go ahead and close this video out. All right, my friends, there you have it. We definitely went a lot deeper in this edition than we typically do into the kind of recent price action. But the reason was to hopefully provide an explanation for what we've observed over the last few days and to give you that understanding such that the next time we see the same thing happen, we can look at it for what it is. It's a kind of technicals driven, albeit having a couple of those macro factors that contributed and helped kind of like push the peg out of that foundation. But ultimately, these are sats that are on sale, so it's a good thing for us stackers. And we took a look at kind of peeling that apart and looking at everything that's happening. So check out some of the tweet threads that I was referencing and that I will link in the description down below. And then we looked at the recap of some of the El Salvador news. But perhaps the kind of crown jewel of this edition is all things Jack Dorsey and him leaving Twitter to focus on Square and the other kind of entities within that umbrella. But I think we are going to see some truly, truly awesome stuff coming out of this. Jack's going to be more focused on this than ever. And we've obviously seen his ability to build really world-class teams that bring consumer-facing products to the masses. And so I think this is very bullish for Bitcoin, as they say. So we're going to leave this here for now. I hope you found this interesting and valuable. If you did, you already know what to do. Give this a like. I'm curious to hear your thoughts and comments down below. Leave me your questions with things you aren't unsure of or perhaps ideas that you'd like to see covered in future videos. I really do take that into account when making the schedule for the channel. But for now, we'll go ahead and leave this here. As always, my friends, every sat counts, especially when you can get them for a discount. And until next time, I'll see you then.